Whether you're pursuing an overall income strategy for investing or just trying to increase your portfolio's yield, preferreds can be a great way to give you that boost of around 9%. If you're unfamiliar with this asset and would like to learn more, I introduce preferred shares in this video. If you're just here for the fun reviews, subscribe to the channel and join me today to review some preferred investing options right here in the red zone. Here's the list of funds we'll review today, as well as some of the things that I liked about these options from a previous episode. If you recall, I didn't like anything about PFFD, so I won't be reviewing it any further. Today, we're going to first compare our ETFs and then compare our closed end funds, HPI and JPC, before picking an overall investment option for my portfolio. Even though we're interested in this asset class for income only, we can't ignore total return. Ignoring total return, particularly in funds that use leverage or a covered call strategy, can provide a false sense of return while your initial investment declines due to something called net asset value erosion. From a total return perspective, it's not even close. PFFA dominates the other two. Next, let's look at their trailing dividend yields. PFFA is over 9% and wins, PFXF comes in second, and PFF trails. As we look a little bit more at consistency and growth, we see that PFFA has increased its dividend consistently over the past 4 years, but its dividend hasn't fully recovered since COVID. PFXF's dividend, although generally growing, is much more inconsistent and includes a large dividend paid at the end of the year, which seems a little outsized in 2024, which is why its trailing yield of over 7% and close to 8%. It could be lower this year. PFFF's dividend is much more consistent, but it's had some years in the past 5 years of dividend declines, and in the past 10 has declined 7 out of those 10 years. PFFA wins this category. Next, let's look at expenses, with both PFF and PFXF being similar, but PFFA has a pretty high expense ratio for an ETF. This high of an expense ratio is primarily due to its leverage, and part of the expenses you are paying are the fund's borrowing costs. This high expense ratio is not uncommon for funds that do use leverage, but remember that your dividend yield or distributions are after those fees are collected. But from a pure expense ratio perspective, the other two funds are obviously lower and win this category. Next, we should look at allocation. The investments in these portfolios are graded much like bonds, so the percentage on the chart is the percentage of assets under management that are rated triple B or higher, which is considered investment grade. PFFF is not only diversified in terms of portfolio, but has a higher level of safety protecting your investment. That generally tracks throughout the comparison of these funds. And what we're seeing is that classic risk reward trade off. If you want a higher yield, you're taking more risk. So PFFF wins from an overall traditional safety measure, but risk is much more than just your grades of your assets. As we look at PFF, we see its total return over the past 5 years is unable to keep up with inflation. Prices, according to CPI, increased close to 25% over the same period of time that PFFF gave us a total return of only 17%. The so called junk status of more than 90% of PFFA's holdings definitely gives me pause, but PFF's poor return gives me more. The final thing to be aware of in terms of risk is standard deviation, which generally tells you the likely movement range of the price of an asset. This is important if you're planning to sell any of these funds to generate your income in retirement. Here at Red Zone Investing, however, I believe that selling your assets can be a part of your strategy, but sole reliance on that is highly flawed, as I covered in this video and this video. We aren't investing in preferreds with the intent to sell. They're generating the income for us so we don't have to. Last, we have style. As I've said in other videos, I don't like bond funds, but to be more specific, I don't like passively managed treasury or government bond funds as they underperform anything you could just do for yourself quite easily, and you pay someone for that underperformance. Active management, however, can generate outperformance in bonds and in preferreds, which behave more like bonds than stocks. And we see very clearly the difference over the past 5 years that active management has made with PFFA. Overall, I like PFFA. Now let's look at our closed end funds. We'll look at some slightly different metrics for these. In terms of AUM, HPI is a little bit smaller of a fund than I generally like, as it's under $500 million dollars in assets. From a total return standpoint, here's how the funds compared over the past 5 years. When we take a look at current yields, we see that JPC has a higher dividend yield, over 9%. But when we look at its history, we see a general lack of consistency, while HPI's lower yield at 8.6% shows much more consistency in the distributions. If I had to pick a winner here, it would be HPI for the consistency. And as we'll see coming up, there could be a dividend cut on the way for maybe both of these funds. Next, we'll look at leverage. Both funds have effective leverage of around 37%, which for me is a little over the general 30% or so leverage that I prefer to stay under when choosing a fund. Although I did not calculate PFFA's current leverage, its prospectus indicates that management keeps its range between 20 to 30%. Next, we have expense ratio, which we are not overly concerned with because of the fund's leverage. But what is interesting here is HPIs being higher despite both funds carrying the same amount of leverage. Next, we'll look at UNII, whatever that is, you're probably thinking. It stands for Undistributed Net Investment Income, which is the income the fund produced minus its distributions. In general, we'd like the fund to pay out its income or maybe even keep some as a reserve. Two different metrics we could look at are relative UNII or UNII per share. We also want to look at the trend, as the trend will inform us if we should be concerned about a potential dividend cut in the future. So, the situation for these funds doesn't look great, but let's expand our view to earn coverage. Earned coverage is expressed as a percentage and is the income over the dividends. This metric is most useful for pure bond funds, and in a perfect world, for those funds, you would want the earned coverage to be close or equal to at least 100%. However, neither of these funds are pure bond funds, they are a mix with preferreds. So, what should we expect? We would want the earned coverage to at least equal the bond allocation, as some of the distributions might be getting generated, although not that likely, from capital gains. Since these are close, in order to know which one we might be more concerned with, let's look at another similar fund from Cohen and Steers and its limited duration preferred and income fund, ticker symbol LDP. We can see it holds only about 30% preferreds, with JPC holding 40% and HPI holding over 80%. So we should expect JPC to be covering its distribution via earnings at generally a higher rate than HPI. But that's really not the case. So HPI is winning this round. Next, we'll take a look at allocation and risk, and it appears JPC has higher credit quality of assets than HPI. So, in the event of a crisis, JPC should hold up a little better. Let's take a look at the last crisis and see if that was the case. If we look at the GFC in 2008, both funds, like everything else in the market, got creamed. But JPC does seem slightly less volatile, although HPI had a run up prior to the climb. What is interesting is that HPI's dividend was much more sustainable, with JPC cutting, then changing its distribution policy to quarterly, then changing it back to monthly, and overall being less consistent. In the last round, we'll take a look at Z score, which basically tells us how many standard deviations the price is from its historical premium or discount. In general, we are looking for a negative 1.5 or less to be present, and that would mean it's a great buying opportunity for the fund. But a low positive Z score close to zero shouldn't stop us from investing. We should just understand the reasons and if we expect those reasons to continue into the future. Here we see JPC's Z score of 1.6, indicating it's probably not a great time to invest, with HPI telling us it's trading at a premium, but only slightly more than what is traded in the recent past. Overall, these two funds are super close, as you can see. In this case, I'm going to pick HPI, primarily because if our earn coverage is trending down for both, HPI's dividend seems more consistent historically, where if current trends continue, JPC could be the first to cut. HPI is also currently trading in a more reasonable range. To review, from the ETFs, I picked PFFA, although its junk holdings are a concern. I also picked HPI from the closed end fund, but because earned coverage is trending down, its 5 year total return is less than half of PFFA, and its dividend yield is lower than PFFA's. I'm naming PFFA as the winner in this battle of funds. So, what am I doing with this information as I transition my portfolio in the red zone? I'm allocating approximately 6% of my overall portfolio to PFFA. So, which fund most interests you? Leave a note in the comments section to let the community know which preferred fund you have in your portfolio and why you like it. To see how I'm going to allocate the rest of the income producing part of my portfolio, hit that like and subscribe button and join me next time right here in the red zone.